You know, in the previous video on Control Your Nerve to Control Trades, we talked about how a trader's greatest weapon isn't his system or his chart, it's his own composure. Today, I want to talk about something that builds right on top of that, how to build a position like a professional trader. Because make no mistake, trading isn't about being right once. It's about being right and staying right while the market pays you for it. Now, let's get one thing clear from the start. Building a position isn't about buying all you can, all at once. That's what amateurs do when they get excited about a story or a tip. Professionals don't throw money at an idea, they test it. They feel out the market like a hunter testing the wind before he takes aim. Tell me, have you ever noticed how the best trades seem to unfold slowly, step by step, not in one dramatic leap? That's because real traders build into strength, not into hope. When I enter a trade, I never go all in. Never. The first purchase is just a prober feeler. I want to see if the market confirms my judgment. The market is never wrong, opinions are. If my initial position starts working, if the stock behaves as expected, showing strength, holding its gains, refusing to give back too much, then I add. Carefully, deliberately, like a builder laying brick upon brick. But if it doesn't, I'm out before I get hurt. Quick, clean, and without regret. You see, the professional trader knows that his capital is like his ammunition. You don't waste it firing at shadows. The amateurs, they buy because they're afraid of missing the move. They fear the market running away without them. But let me ask you what's worse. Missing a trade, or getting caught in a bad one. You can always find another opportunity, but you can't trade if your capital is crippled. Professionals know this. They don't rush. They stalk their trades. They build slowly, adding only when the market proves them right. And this is where discipline comes in. Discipline isn't just about cutting losses, it's about holding your fire. Most people can't do that. They want excitement. They think trading is about constant action. But trading, real trading, is about waiting for confirmation. You wait for the market to show you it's moving in your direction. Then you press. Then you build. One unit at a time, never too heavy, never too eager. I remember many traders who made fortunes in the bull markets and lost them in the bear phases because they built positions backward. They averaged down, not up. They thought they were being smart buyers by lowering their average cost. But the market doesn't reward stubbornness. It rewards alignment. Averaging down is just another name for hoping. Hope is not a trading strategy. Would you add to a losing hand at the poker table just because you liked the cards? Of course not. Then why do it in the market? Building a position correctly means adding only to proven strength. When a stock breaks out and confirms your judgment, that's your cue to step in again. But do it in small increments. Don't double up recklessly. Let each addition earn its right to be there. You're not trying to catch the exact bottom, you're trying to ride the middle of the move, where the probability is highest. That's where the professionals make their money. Now, remember how in that last discussion about controlling your nerve, we talked about not letting emotions drive your decisions. This is exactly where that lesson pays off. Building a position the right way demands nerves of steel. The market will tempt you to jump early, to add too fast, or to hold too long. But you can't let excitement or fear dictate your timing. The calm trader, the one who waits for confirmation before adding, that's the one who lasts. Every great trade I ever made had one thing in common: the market confirmed my idea before I pressed it. I didn't argue with price, I followed it. That's the key, never fight the tape. If it goes your way, you feed it a little more. If it doesn't, you get out. Simple, but not easy. The trouble is, most traders can't stand being wrong even for a minute. They take it personally. But trading isn't personal, it's business. The market doesn't care who you are. It rewards precision, patience, and courage in equal measure. When you're building a position, you've got to think like a general commanding troops. You don't send your entire army into battle at once. You send a small force first, see how the enemy reacts. If the ground is favorable, you send more. If it's not, you retreat and conserve your strength. Trading is war against your own impulses as much as against the market. Another thing, Never forget that price movement alone is your only reliable signal. News, opinions, forecasts, they're all noise. The market tells you what it wants to do through its action. If your first small position starts to show a profit, that's the market saying, you might be right. Add a little. If it keeps working, add again. But the moment it hesitates, or the moment your additions stop producing gains, that's your cue to stop. Professional traders know when to press and when to pause. Do you? Too many people want to be heroes in the market. They want to buy big and be right big. But the professionals, they'd rather be right small at first and build into being right big. That's the difference between gambling and trading. A gambler bets on hope, a trader bets on confirmation. And don't misunderstand me, it's not about greed. It's about method. The market rewards methodical thinking. When you build a position properly, you're giving yourself room to be wrong without being ruined. That's the secret most people never learn. A professional trader isn't trying to be right every time. He's trying to manage risk so that when he is right, he can make the most of it. You have to remember, too, that wealth in trading comes from compounding correct behavior, not just compounding capital. Each trade teaches you something about patience, about timing, about control. When you build a position the right way, you're reinforcing those lessons in real time. You're telling your mind, I act on evidence, not emotion. And that habit, more than any chart pattern, makes the trader wealthy in the long run. So, before you even start building your next trade, ask yourself, am I entering because the market confirmed my view, or because I'm eager to be right? If you can answer that honestly, you're already ahead of most people who click the buy button out of impulse. Because building a position like a professional trader isn't a tactic, it's a mindset. It's the patience to wait for the right signal, the discipline to add only when proven right, and the nerve to do nothing when the market says wait. Most people won't do it. That's why most people lose. But the ones who do, those few who can hold their nerve, act with precision, and let the market lead them, they're the ones who rise from the crowd and stay there. And that's the kind of trader you want to become. Not the one chasing every move, but the one quietly building his position while the market gives him permission to do so. Build positions only when the market confirms your judgment. That one sentence carries more weight than any trading book ever printed. Most traders get it backwards. They form an opinion, then they rush to prove it right by forcing a position. Professionals, on the other hand, let the market prove their opinion before they commit. You see, the market doesn't care what you think. It doesn't care about your analysis, your conviction, or your gut feeling. The only truth that matters in trading is price action. When I take a trade, I never assume I'm right from the start. I assume the market will test me. It always does. That first position I take is small, deliberate, almost insignificant in size. It's not there to make me rich, it's there to test whether my idea holds water. If the market starts moving my way and continues to behave as I expected, that's confirmation. That's the green light to add. But if the price action starts wobbling, hesitating, or worse, reversing, then I know my judgment was off. And I don't argue with the market, I step aside. Think about it this way, every time you enter a position, you're entering into a conversation with the market. Your trade is your statement. The market's response through price movement is its reply. If that reply agrees with you, then you have confirmation. If it contradicts you, that's rejection. Why would you argue with the market when it's clearly speaking? The amateurs do. They keep insisting they're right. They say, the market's wrong, it'll come back, but it never does on command. The professional listens and adjusts. Confirmation comes in many forms. Sometimes it's a breakout that holds above a key level. Sometimes it's volume expanding as price rises. Sometimes it's a clean rejection of a support zone that holds firm. You have to learn to read the message hidden in price. The charts aren't just lines and candles. They're footprints of money, fear, and greed moving in real time. When big money steps in, you'll see it. The price will move with conviction. That's when you start to build. But never before. Have you ever noticed how the best moves in the market almost invite you in? The price seems to rise effortlessly, and every small dip gets bought back quickly. That's confirmation in motion. It's the market telling you, you're on the right track, come along, but stay sharp. The worst moves, on the other hand, feel forced. The stock goes up a little, then back down, then up again with hesitation. You can feel the uncertainty in the chart. That's the market whispering, something's not right here. Professionals hear that whisper, amateurs ignore it. Now, here's the tricky part: confirmation doesn't mean perfection. It doesn't mean you'll catch every move from the bottom or exit right at the top. It means you're aligning yourself with the probabilities. You're waiting for proof before you commit. Most traders lose not because they're completely wrong, but because they're early. They act before the market has confirmed the direction. They buy a stock that's cheap because it's fallen, but they forget that cheap can become cheaper. They sell short because a stock looks too high, but they forget that high can go higher. Only price action, clear, undeniable confirmation separates a good setup from a dangerous assumption. And let's not forget what we discussed in the previous video about controlling your nerve. This principle ties directly to that. Waiting for confirmation requires patience, and patience requires control over your emotions. It takes nerve to watch a stock move without you and resist the urge to chase. It takes nerve to sit still while everyone else is jumping in early. But that restraint, that quiet discipline, is what saves you from losses that others call bad luck. It's not luck, it's timing. And timing comes from waiting for the market to show its hand. When you start trading this way, your mindset changes. You stop feeling like you have to predict the market. You become a follower of strength, not a forecaster of turns. You stop trying to be right and start trying to be in sync. The market rewards synchronization, not stubbornness. You'll find that your entries become smoother, your drawdowns smaller, and your confidence steadier, not because you're suddenly smarter, but because you're finally listening to the only voice that matters: price. There's something liberating about trading only when confirmed. You no longer fear missing out because you know there will always be another signal, another setup. You're not married to your opinions, you're married to the evidence. The market will always show you when it's ready to move. You just have to be patient enough to wait for the invitation. That's why professional traders spend hours watching, studying, and waiting. Their biggest advantage isn't secret information, it's restraint. Here's a simple truth: price confirmation is proof of participation. When you see confirmation, it means other traders, especially the large, institutional ones, are stepping in. You're not trading against them, you're trading with them. That's the safest place to be. But when you act without confirmation, you're often stepping in before the big players have committed. That's why your trades feel lonely and uncertain. You're fighting the tide instead of flowing with it. So when you're looking at your next setup, ask yourself: has the market confirmed my judgment? Has the stock proven that my analysis is correct? If not, why am I in a hurry to risk my capital? Let the market do the heavy lifting. Your job is to wait until it shows its intention, because once it does, the path forward becomes clear. And once you've learned to wait for confirmation, everything about your trading evolves: your entries, your ads, even your exits. You start thinking like a strategist instead of a speculator. You stop reacting to noise and start responding to evidence. You build positions not on faith but on proof. That's how professionals operate. They don't hope for the market to agree with them, they wait until it already has. Build into strength, not into weakness. Those 5 words draw a line between the professional trader and the hopeful amateur. Every trader thinks they understand it, but few actually live by it. To most beginners, buying into weakness feels logical after all. Prices are cheaper, and who doesn't want a bargain? But the market isn't a store. You're not shopping for discounts. You're aligning with momentum. In trading, strength isn't something to fear, it's something to trust. Weakness, on the other hand, is the market's way of warning you that something isn't right. When a stock is showing strength, it means demand is in control. Buyers are willing to pay higher prices, and sellers are running out of supply. That's when trends are born. That's when you see clear direction, tight pullbacks, and heavy volume supporting every upward move. Those are the moments professionals wait for. They don't chase random dips hoping for a rebound. They add to positions when the tape proves that the market is moving in their favor. Why guess when the evidence is right there? Now, think about the flip side, building into weakness. What does that really mean? It means you're buying a stock that's falling or holding on to one that keeps slipping lower. You're adding because the price dropped, not because it confirmed anything. That's not strategy, that's emotion wearing a trading jacket. You tell yourself it's just a pullback, or it can't go much lower. But the market doesn't owe you a rebound. Every tick down against you is the market saying, you're on the wrong side. And yet human nature makes us want to fight that message. We want to be right so badly that we start throwing good money after bad, hoping to average down to a better price. But professionals never average down, they average up. They add only when strength proves them right. When you build into strength, you're aligning with confirmation, not hope. You're letting the market earn your confidence one move at a time. The first entry is always small, a feeler position. You watch how the market reacts. If your stock moves higher and holds its ground, you add a little more. Each new purchase sits above the previous one, so if the move reverses, you're still protected. You're building a pyramid of strength, each layer supported by market confirmation. If that pyramid collapses, you lose small. If it continues to rise, your profits multiply with the trend. That's how a professional trader survives long enough to catch the big moves. Have you ever noticed how the strongest stocks seem to stay strong longer than anyone expects? Everyone says it's overbought, it has to come down. But strength breeds more strength. Institutional money flows where momentum lives, and that money doesn't turn on a dime. When a trend is truly strong, corrections are shallow, rebounds are quick, and new highs come sooner than skeptics can react. Building into that strength doesn't mean chasing blindly, it means adding intelligently as the trend proves itself. Weakness, on the other hand, invites emotional traders to act against their better judgment. They think they're buying the bottom, but in reality, they're catching falling knives. The market punishes that behavior because it rewards confirmation, not anticipation. Weak stocks are weak for a reason. Something fundamental, technical, or psychological is wrong. The price action tells you so. And if you keep building into that weakness, all you're doing is magnifying your losses. It's like trying to swim against a rip current. It doesn't end well. This idea ties directly to what we discussed earlier about controlling your nerve to control trades. Waiting for strength before adding requires a calm mind. It's hard to do because it feels uncomfortable to buy at higher prices. The untrained trader feels safer buying cheap, but that's an illusion. In truth, you're safest when you're following momentum, because momentum is proof that the market agrees with your thesis. When you add to a position showing strength, you're not being reckless, you're being logical. The market is validating your move. That's the discipline we talked about before, the ability to hold your nerve and trust the action, not your emotions. Building into strength also teaches you patience. You can't just pile in because a stock twitched upward once. You wait for structure, higher highs, higher lows, expanding volume. You want the chart to prove that buyers are in control. Then, and only then, you press. You don't need to predict where the top is. Professionals don't try to catch the absolute bottom or sell the absolute high. They aim to live in the middle of the move, where the path of least resistance is clear. That's where building into strength shines. Now think about your own trades. How many times have you added because the stock looked cheap, only to watch it drop even lower? And how many times have you hesitated to buy more because it felt too high, only to see it keep climbing without you? That hesitation is emotional bias disguised as caution. The market doesn't care about your comfort zone. It rewards courage backed by evidence. When you see strength, that's your evidence. That's your chance to step up with control and precision. When professionals build into strength, they're managing both risk and opportunity. Each new addition is funded by unrealized profit from the earlier ones. That means the market is paying for the trade, not their capital. Contrast that with building into weakness, where every addition digs a deeper hole. One is a disciplined expansion of opportunity, the other is a desperate act of denial. Strength isn't just about price moving up, it's about character in the move. Is the stock showing tight consolidations, strong closes, and rising volume? Are buyers defending pullbacks quickly? Those are signs of institutional support. When you add into that kind of environment, you're not fighting the tide, you're sailing with it. The current is doing the work for you. But if you add when weakness dominates lower highs, heavy selling, fading volume, you're rowing against the current, exhausting your account with every stroke. The best traders think of strength as confirmation of harmony. The market and the trader are moving together, not in conflict. When the market confirms your direction, that's your signal to act. When it doesn't, your job is to wait. Building into strength means you respect the market's rhythm. You move when it moves. You pause when it pauses. You never force the action. The market is the conductor. You're just following the tempo. Add to winners, never to losers. It sounds simple enough, doesn't it? Yet it's one of the hardest principles for most traders to live by. The human mind is wired backward for trading. It wants to do the opposite of what the market rewards. When a position goes against us, we feel an urge to fix it by adding more, as if we can force the market to agree with our opinion. And when a trade moves in our favor, we become cautious, afraid to add in case we jinx the profit. But professional trading turns that instinct on its head. The professional doesn't defend weakness, he feeds strength. Adding to winners is the art of pressing your advantage when the market confirms you're right. It's not gambling, it's strategy. You start small, test your idea, and let the market tell you if your analysis is correct. If your position begins to show profit and the price action continues to validate your thesis, that's your cue to build. Not recklessly, not impulsively, but methodically, one layer at a time. Each new addition is justified by the strength of the trend, not by hope or emotion. That's how professionals turn good trades into great ones while keeping risk under control. Now, let's look at the opposite, adding to losers. This is the emotional trader's trap, the quicksand of the market. You buy a stock, it starts to drop, and instead of cutting it, you add more to average down. You tell yourself it's temporary, that it's cheaper now, that the market's overreacting. But in truth, what you're doing is surrendering control to your ego. You're not trading the market anymore, you're trying to save face. The market doesn't care about your average price. It doesn't care that you deserve a rebound. Every addition to a losing position is an act of defiance against price reality, and price always wins. The professional knows better. He doesn't argue with the tape. If the market moves against him, he exits quickly, cleanly, without regret. He saves his ammunition for when the tide turns in his favor. Adding to a winner is his reward for patience. Avoiding losers is his protection from ruin. Have you ever noticed how quickly a losing trade can drain not just your capital, but your confidence? It's like a slow leak that eats away at your composure. But a winning trade handled properly does the opposite. It builds momentum, clarity, and discipline. Adding to winners isn't just about profit, it's about reinforcing the right habits. When I say add to winners, I don't mean blindly piling on every uptick. It's a process of confirmation and control. You add only after the market proves your position is working. You wait for pullbacks that hold above previous support levels or for breakouts that occur with conviction. Each addition should be placed strategically, so that, if the move fails, your loss is limited. Professionals think of each new addition as a separate bet within the same trend, each one funded by the profit of the previous. That's how you scale safely using the market's money, not your own. Amateurs fear buying higher because they think it means overpaying. But in trading, higher prices often mean higher probability. A rising price proves demand is outpacing supply. The trend is alive, and you want to be where the strength is. Adding to a winner in that environment isn't chasing, it's aligning with momentum. Would you rather add to a stock that's confirming your analysis, or to one that's punishing you for being early. Adding to losers, on the other hand, is just an emotional negotiation with pain. It's the mind saying, if I just buy a little more, I can get out at break-even. But break-even thinking is the language of desperation. The market doesn't hand out mercy exits. It teaches lessons. The professional learns them once, the amateur repeats them until the account is gone. This concept ties perfectly with what we discussed in the previous session about controlling your nerve to control trades. It takes real nerve to add to a winner because it feels uncomfortable. Your mind tells you the profit might disappear the moment you add. It whispers fear while the chart is showing confirmation. You need emotional control to silence that voice and act on logic. And it takes even stronger nerve to cut a loser without trying to fix it. That's why trading isn't just about charts, it's about psychology. You're battling yourself as much as the market. Adding to winners also reflects the mindset of respect toward the market. It's saying, I trust what the market is showing me, not what I wish to see. It's discipline disguised as courage. You're letting the market lead, and you're stepping forward only when it gives permission. Each winning addition is like placing another brick on a foundation that's already proven stable. Contrast that with adding to losers you're stacking bricks on sand. No matter how careful you are, the whole thing collapses eventually. Think of it in terms of probabilities. A trade that's working in your favor has already shown strength. The probability of it continuing is higher than that of a losing trade suddenly reversing just because you want it to. Adding to winners keeps you aligned with the flow of money in the market. It puts you on the side of strength, where institutional traders, funds, and trend followers operate. Adding to losers isolates you in the zone of weakness, fighting the very forces that move prices. When you add to a winning position, you're amplifying success under controlled conditions. You're scaling up exposure only when the market has validated your judgment. The beauty of this approach is that even if the trend eventually turns, your core position has already paid for itself. Your profits from earlier entries cushion you. You've built a position funded by success, not by stubbornness. Adding to losers does the exact opposite. It compounds your mistakes. Every new position you add digs the hole deeper, demanding an even larger reversal just to break even. And here's the worst part, it distorts your perception. You become emotionally invested in seeing the trade recover, which blinds you to better opportunities elsewhere. You end up trapped, holding a position that controls you instead of the other way around. A professional trader's rulebook is short, but sacred: never average down, never fight weakness, and never add unless you're being proven right. That's how capital survives long enough to capture the big moves. Remember, the goal isn't to be right all the time. It's to make the most when you are and lose the least when you're not. Adding to winners achieves exactly that. It maximizes your advantage and minimizes your exposure. Every great trend in market history has rewarded the traders who built into strength, those who added as the market kept proving them right. Every collapse has punished those who averaged into weakness, trying to rescue trades that didn't deserve to live. The difference between the two isn't luck, it's discipline. It's the willingness to do what feels uncomfortable because it's correct, and to avoid what feels comforting because it's dangerous. When you learn to add only to winners, your entire relationship with the market changes. You stop chasing redemption and start pursuing confirmation. You stop trying to be right and start trying to trade right. You begin to see each successful addition not as greed, but as gratitude to the market for proving your thesis true. And from that moment forward, your growth as a trader becomes inevitable, not because of luck or prediction, but because you finally learned how to let your winners work for you. Start small, use the first trade as a test, not a commitment. That single idea has saved more traders than any indicator ever could. The difference between a professional and an amateur is often found in how they enter a trade. Amateurs enter with conviction, professionals enter with curiosity. They don't see the first position as a declaration of certainty, they see it as a question posed to the market. They're asking, am I seeing this right? And they let price be the answer. Most traders rush in because they want to be right now. They find a setup, get excited, and go heavy from the start. They think conviction equals courage, but in trading, conviction without confirmation is recklessness. The professional knows better. The first trade is always a test position, small enough to be insignificant if wrong, yet meaningful enough to give feedback. If it starts working, the market is confirming your analysis. If it doesn't, you're out with minimal damage. That's the kind of discipline that keeps you alive long enough to win big when the time is right. Think of that first trade as dipping your toe in the water before diving in. You're not testing your luck, you're testing the environment. Is the current moving in your favor? Is the temperature right? The professional observes how the market reacts to that small entry. If the price holds its ground, if it starts showing signs of strength, that's the cue to add. But if the price falters, if volatility spikes against you, or if support breaks, the test has failed. And what do you do when a test fails? You stop, assess, and move on. No emotion, no revenge, no argument. Starting small also keeps your judgment clear. When your first entry is modest, your emotions stay manageable.